I'm writing this or recording this after we saw another significant drawdown in the market. The NASDAQ is down nearly 7% year to date. The S&P 500 is down about 5% year to date. And individual stock names like Tesla and Nvidia are down even more. Nvidia is down nearly 23% year to date as of this recording, and Tesla is down over 40% year to date. So today I'm going to give you some background, and then I want to give you a step-by-step framework, the actions you should take immediately and underline immediately. I don't know why I've been underlining things on my recent videos. It feels very powerful to say underline that when you invest, you are trying to capitalize on the long-term return opportunities offered by either lending money, bonds, or through investing ARM money in company stocks. But the price of that investment is today and will always be volatility. And what I see over and over again is that people allow fear and emotion to cause them to make changes to their portfolio, which hurts them and their long run. And that's not to say that the fears are irrational. I could run through a list of things we've been through over the past few decades. The tech crash in the 90s, the great financial crisis in 2007, 2008, and 2009, the COVID crash, and so forth. And what you see in every one of those situations, and we can go back and look a lot further. I mean, we can just keep going decade by decade, pointing out economic crises that we've been through. And what we see is that the people who stayed invested came out better than the people who responded to the short-term fear and volatility. Trading in and out of short-term volatility risks doing irreversible damage to your upside and potentially even to your retirement plan if you are in retirement or nearing retirement. And this is a really important point. Even if you can accurately predict a recession or an economic downturn, you can't necessarily predict the market because markets are forward-looking indicators and often have priced in the data that you are now grappling with. One of my favorite investing authors of all time, a guy with the name of Howard Marks. He has a podcast, he puts out a monthly memo. He's been investing for over 50 years. I read anything he puts out. He said this reducing market exposure through ill-conceived selling and thus failing to participate fully in the market's positive long-term trend is a cardinal sin in investing, turning negative fluctuations into permanent losses and missing out on the miracle of long-term compounding. As another one of my favorite authors writes, a guy by the name of Sam Rowe. He has a great newsletter on investing, says the path to long-term riches in the stock market is riddled with stomach-churning volatility. And as someone who's been investing since the early 2000s, I can tell you that is 1000% true. So to double down that point or to reinforce that point, if you would only own the US stock market on the day after it was up, so the mark was up, you're feeling good, you invested, and we're talking about the S&P 500 since 1993, your nominal of gain would have been 44% if you'd only owned the market on days after the market was down. So the market's down, you're not feeling great. You buy the market, you'd be up 850% or 51%. If you just bought and held, you'd be up over 12% in that same kind period. So some of you are watching this, you're like, okay, so you're telling me I should do nothing? Absolutely not. So here's what I want to do. I want to walk through a framework to help you understand the changes you should potentially make to your portfolio. So here are 3 steps that you need to take immediately. First of all, you need to figure out your short-term cash needs. Figure out how much cash you need from your portfolio over the next 2 years. If that money is invested, it shouldn't be. It needs to be in a very safe bucket. Put it in the ultra-short government treasuries or a money market fund or CDs. Put it somewhere that is safe and liquid. That means if you're going to buy a house with the cash you have invested in the next 2 years, pull that money out. That means if you're retiring this year and you're going to need to pull money from your portfolio for the next couple of years to live on, that money should not be invested in the market. So first of all, if you need the money in the next 2 years to live on or to buy a house or do whatever, you should put that in a safer bucket. Next, let's look at some of the intermediate needs. Figure out how much cash you need from your portfolio over the next 5 years, and that money should probably be invested in some sort of safer bucket. Now, I want to avoid investment advice, but I would tend to skew towards using maybe intermediate bonds or something like that for that next portion. Why? Because you want to match duration or try to attempt to get closer to matching duration. So what I tell clients is we want to have 3 buckets. We want to have one bucket that has about 2 years of cash money we're going to need in very short term. Then we want to have another bucket that's 5, 6, 7 years of living expenses that's invested in some sort of fixed income instrument, because what we're trying to create is a fairly safe bucket of money. So if we have to sit through a prolonged market downturn of 2 years or 4 years or 6 years or 8 years, We can continue to spend the money we need during retirement, or wherever you are in life, whatever stage you're at in life. Think through, if I need this money in the next 5, 6, 7, 8 years. I don't want to have that money invested in the market because we just have no idea what's going to happen in the short term. So you've got your first bucket, which is basically cash, and you've got your intermediate bucket. Then you have the longer term bucket. And what we do for our clients is we invest it in a balanced equity portfolio. The people feeling the most pain today had gotten addicted to the drug of US growth stocks, and they're feeling a lot of pain. But people with the balanced portfolio are feeling a lot less pain this year. Let me show you a crazy chart. This is using some of the ETFs that we use as a firm. I'm not going to tell you what those ETFs are because this is not investment advice. But as of today, the S&P 500 is down about 5%, the NASDAQ is down about 7%. But if you'd had a more balanced portfolio with some value and some international funds, you would be much better off. So let me just give you a few examples. The value ETF that we use is up 11% year to date. Our core international fund is up nearly 8% year to date. Our emerging markets value fund is up 3% year to date. We use a global real estate fund. I think it's up 3% year to date. So if all your money is highly concentrated, you need to diversify. If you do diversify immediately, but then once you've taken those 3 steps, you've spread your money out, you've got some money for the next couple of years, then you got another bucket that has a big chunk of money for the next 5, 6, 7 years. And then you've really diversified your portfolio across the globe and across globe growth and value. Close the computer and walk away from the portfolio and go enjoy your life. I tell my clients all the time, I don't know much with certainty, but I do know that over your retirement, you're going to experience some incredible financial turmoil in the market. It's just going to happen. In fact, the data tells us we're going to see a 20% downturn, probably 4 or 5 times, during the average person's retirement, 20% or more. And it will often take us by surprise. But even if we could predict the crash, the issue is we never know when to get back in. The number of people that I have talked to who told me, oh, I was smart enough to get out of the market, whatever, right before whatever crash. And then I talk to them and they're still invested in cash because they could never figure out a time to get back in, and they missed out on incredible up opportunities in the market. I have no idea what's going to happen over the next 4 years. I have no idea of the outcome. And even if I did, I don't think I could predict how the market would respond, especially if I have a well-diversified portfolio. So we never have any idea about how the markets are going to perform. We just don't. Anyone who tells you that they know how the market is going to perform, they're just lying to you or they're delusional. Nobody does. But we should always position ourselves for the worst and then continue on with our lives. I've consistently seen one common theme in my years of study in the market. As I said, I began investing in the early 2. Those who think they can outsmart the market are the ones who end up feeling the most market pain and who ultimately put the retirement most at risk. So create a plan and stick with it. This has been proven over and over again to be the best path forward, no matter what our current market turbo.